All right, in this lesson, we're going to be talking about shipping terms. Now, to kind of discuss why we're talking about shipping terms, when we're talking about the income statement, we have to understand kind of what provokes the theory or the reasoning for shipping terms. So let's ask a little bit of questions to you and see if you have an answer to this. And then we'll talk a little bit about this shipping term. So what if, say, you're a company that purchases items from China to sell in the United States, and the vendor puts that product on a ship bound for Los Angeles, California. So we've got a vendor abroad, and that vendor puts the products that we have ordered on a ship, and that ship is supposed to sail to the United States. Now, obviously that takes a little bit of time, and it's in ocean the entire time. And so the one question that you need to then ask is, on day 5, that ship sinks, who pays for the replacement? So does the vendor pay for the replacement? Do you pay for the replacement as the company who's buying it from the vendor? Or does the shipping company pay for the product? Well, the first answer is that it's not the shipping company, because a lot of times the shipping company will have you sign a release or have you release them of any liability associated with getting your package from point A to point B. And we know that because when you head to the post office or you head to FedEx or UPS, a lot of times they'll ask you, do you want to purchase insurance? So it's another level of service that you have to purchase. So we know that the ship is not responsible for it because the vendor would have released the shipping company from liability of those products while it moves through the ocean. So now we get down to the nitty-gritty of, is it the vendor or is it the purchaser? And that creates a complex problem, and that's why we have something called shipping terms. Shipping terms allows us to definitively say who actually owns the product when it's on the ship and who doesn't own. It's kind of like, when does the title transfers, and whoever has the title when that accident happens is responsible for the replacement of the good. So that's why we're talking about shipping terms in this lesson. So here are some basics about shipping terms. So shipping terms are the stated terms of the sale of a goods between two parties. Now, generally speaking, there are 2 basic types of shipping terms. There actually is a lot of different ways you can ship things, but these are the 2 main basic ones, and then everything else is a derivative of these 2. The first basic type of shipping term is the FOB shipping point. So FOB means free on board. So free on board shipping point, FOB shipping point. The other basic term that we use is FOB destination point, free on board destination point. So depending on how your contract is set up and your sale is set up, it could either be shipped FOB shipping point or FOB destination point. And both of them basically will tell you when the title transfers from the vendor to the customer. So let's take a look at each one of these a little bit more in depth. We're going to start with FOB shipping point. Now, FOB shipping point means that the title transfers of the goods, or the title of the goods transfers at the point the vendor hands the product to the commercial shipper. So I've got a picture here. We've got the vendor here, and then we've got the customer here. And typically we're going to go from the vendor to the customer. So the title transfers as soon as the vendor gives the product to a common carrier or a commercial shipper. Don't get too technical here with the word commercial or common shipper. Just if they give it to the shipper, title has transferred. So as soon as I give the products to UPS or FedEx or the United States Postal Service, then it's their control. That means that the customer owns that product. So title transfers at the shipping point, okay? So with a little bit about FOB shipping point, if title transfers at shipping point, anything that happens to the product is the responsibility of the customer and not the vendor. So the vendor is released of any obligations once they've shipped the product, aka shipping point. The customer will book the inventory into their books on the date the product is shipped, not necessarily when they receive it. So, we've been talking about inventory in this section. Well, when the vendor ships the product, then that product is part of the customer's inventory, even though the customer has not received that inventory. So because the title has transferred, it is now owned by the customer, and as such would be reported in their inventory numbers. Okay. The vendor will book the sale when the goods are handed to the commercial shipper. So when the vendor hands that product to the shipper, then technically speaking, the vendor can now book a sale and book the cost of goods sold. So they can book both of them because the transaction is effectively complete at that point in time. So again, knowing the intricacies of these shipping terms are so important to giving us accountants the timing of when entries are made. Now let's talk a little bit more about destination point. So FOB destination point, title of the goods transfers at the point the commercial shipper hands the product to the purchaser. So for instance, we've got the vendor and the customer, and we go this way. And so the vendor gives the product to the shipper, but it's still owned by the vendor, not the customer. Now, once that commercial shipper drops it off or delivers it to the customer, the sale is complete. The title has transferred at this point in time when the customer gets it. So that is what FOB destination point means. We transfer the title at the destination rather than at the shipping point. Again, a little bit of more information about FOB destination point. If the title transfers at the delivery point, anything that happens to the product while in transit is the responsibility of the vendor and not the customer. So the vendor is responsible for the replacement, not the customer, because the customer doesn't own it until it arrives. Now, the customer will book the inventory into the books on the date the product is received. The vendor will book the sale when the goods are delivered to the customer. So when the vendor gives that product to the common shipper, it is still there. So no sale has been completed, as well as no cost of goods sold has been incurred. And so technically the shipper would have to wait, the shipper, which would also be the vendor, would have to wait to book the revenues and the expenses until they arrive. Now, for most businesses, the time between transit is very short, so it's usually not a huge problem for the vendor to go ahead and book that sale when they've shipped the product, which is usually what happens. But at the end of the year, an adjustment's going to need to make sure that the right sales are in the right period, especially if a product is in transit. So keeping an eye of when did the sale actually occur, making sure that sale occurs in the right period based on the shipping terms. Now, shipping terms are part of the negotiated price paid for the product. FOB shipping point usually means the product is cheaper than FOB destination point. And the reason why is who's taking the risk when it's being shipped. So if it's FOB shipping point, that means the vendor is taking a lesser risk than the purchaser. So the purchaser doesn't want to pay a high price for it, because if that product gets damaged, the purchaser or the customer is going to have to replace it on their own dollar. Vice versa does happen if it's shipped FOB destination point. The shipper or the vendor is going to have more risk in this sale, and therefore typically the vendor will price their products higher than if they sold it at FOB shipping point. So this is a great way to actually negotiate the price of a product based on who's going to take the risk. Now, a lot of companies do try to negotiate down and do FOB shipping point rather than destination point, and then whatever difference that is saved take some of that to buy insurance from a third party so that it's still insured. It's just they're not paying an inflated price that the shipper would normally charge. So again, this is a great ploy from a negotiation standpoint to reduce the cost of your product, because by reducing the cost of your product, you have a little bit of a better competitive advantage on price for your customers. So doing anything you can to lower that price, and this is one way you can lower it. Remember that when we talk about FOB Shipping Point and Destination Point, when we book the sale or when we book the expense is critical to the shipping terms. So that is a look at shipping terms and understanding what FOB Shipping Point means, as well as whatever FOB Destination Point is, and when a sale actually occurs and when a expense actually is incurred by a company and when they need to book it into their books. So that is a look at shipping terms. We hope you enjoyed this lesson, and I'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.